Hello and welcome to our discussion on preparation of the financial statements. In this session, we will pick up certain transactions of an existing business. When I say existing business, I mean there are certain sources and certain assets. In other words, an existing business will always have an opening balance sheet. With this opening balance sheet, there are certain transactions. So using these transactions and opening balance sheet, we'll prepare the financial statements. But once again, our focus will be on the cash flow and then converting the cash flow from the receipts and payment to the CFO, CFI and CFF, and then also once again converting a direct method of CFO into indirect method of determination of CFO. The question information given is the sources and the assets. The assets and sources are not directly given. Some compound items, composite items like capital employed, equity and other related information is given. So first let us prepare the opening balance sheet. Opening balance sheet will show the assets and the corresponding sources as on 1st April 2010. So this is the information given. On 1st April there is a capital employed 350,000 and capital employed consists of 90% of the capital employed is equity and the balance is the bond. So while preparing the financial statements or opening balance sheet, let us use this information. So the capital employed given is 350,000. And it says that equity is 90% of the capital employed. So equity is 90% of capital employed, 0.90. So the balance is the debt or the bonds. The balance is 10% bonds. When we say 10%, it is a rate of interest. It's a rate of interest. So let me write down as 10% bonds. 10% bonds. And equity consists of the capital and the reserves or the retained profit, and it says that the 90% of the capital employed is the equity and 20% of equity is a capital. So 20% of equity is capital. So the balancing figure of equity is retained profit. So this equation is actually, this information tries to strengthen our understanding of the capital employed. In a balance sheet, instead of showing capital employed, we show capital, retained profits and the bond. So the opening capital is 63,000. Opening retained profit is 252,000, and this is at the beginning of 2010. And the bonds, 10% bond is a balancing figure, that is 35,000. Together 350,000 is the capital employed. And then it says that there are creditors 150 and outstanding expenses 25,000. So creditors is 250,000 and outstanding expenses is 25,000. So that is the total sources of the balance sheet as on 31st March 2010 or 1st April 2010. And the corresponding asset information is given like this. The assets are plant original cost 180,000, accumulated depreciation 36,000. So let us put that. So plant is 180,000 and accumulated depreciation, let me write down AD, is minus 36,000 minus 36,000. Debtors receivables is 25,000. Stock stock is 75,000. Then stock is 75. Shares of XY Limited, so shares, okay, XY shares is XY shares is 150,000, and balance is the cash. How much is the balance? Is 532 minus this, okay, minus this, minus 75 minus 150. So cash will be 131,000. So this is the cash as a balancing figure. So the opening balance sheet information has been put into in the form of a balance sheet, and one of the important issues here is understanding capital employed. Now with this information we undertake the transactions. The transactions are sold entire stock for goods. So for cash, the entire goods or stock sold for 195,000. For cash, you're selling the entire stock for cash. So in the cash flow statement, the opening cash, let us put that opening cash is 131,000, opening cash in hand. Then sales is 195,000, and that is for cash. And whenever there is a sale, there has to be cost of goods sold. Since entire stock is sold, so the cost of goods sold is 75,000, and no stock appears on the balance sheet after the sale. So that sale transaction done. Received dividend, because you have invested in XY shares, so dividend received is an income, though it is a non-operating income. So you're receiving dividend 20,000, and dividend is a cash inflow and income. So dividend will also appear in the cash flow statement. Then issued 1,006% bonds. You have already 10% bonds, but now we are issuing new bonds at the rate of 6% at a premium of 20% on 1st June 2010. Interest is payable on 31st December every year. So we need to make some calculations. So the amount of bonds issued on 1st June is 100,000, and the rate of interest is 6%. So let us calculate interest per month. This is working, so which will help us in calculating other details as we move along. So interest per month is 500, and interest for the year for the period of 10 months, because from June to March, so interest for the year I'm going to show from June to March because of accrual and matching principle. Only for that period we show. So interest as an expense is 5,000 for 10 months. 10 months is June to March. And however, it says that interest is payable on 31st December every year. So you are actually paying the interest for 7 months. So dividend, the bonds here requires a special attention while calculating the interest, and interest is always calculated on the face value, and that is this is called coupon rate, and coupon rate is calculated on the face value. But how much interest, how much bonds you have raised? It says that 1,000 bonds of 100 at a premium of 20%. So bonds, 6% bonds is shown at bonds is 1,000 into 100 into 100, and bond premium is 1,000 into 20, and that much of cash the firm is getting. We are adding them together, 100 plus 120. It's always better to show both bond and the bond premium, because coupon rate interest is calculated on the face value. So cash is collected 120, and the corresponding liability appears on the balance sheet as bonds and the premium. And the next transaction is we'll come back to the interest in a minute. So expenses for the year is 30,000, but expenses paid is 25,000. So payment of expense is 25,000. So there is an outstanding expense will increase by 5,000, because expenses for the period is 30, paid is 25, so liability is 5,000. After expense, they say that company declared dividend, but we'll discuss the dividend only after determining the profit. And whatever cash available after making all these payments, 50% of the cash will be used to purchase more shares of X. We'll see that these two at the end. So now this will give us profit before depreciation, interest and tax. So profit before depreciation into PBDITA is 110,000. Now let us show the depreciation. Depreciation, you can see that depreciation, some information is given. Company uses reducing balance method, and the rate of depreciation is 20%. So plant cost is 180,000. Already you have depreciated. Depreciation has happened of 36,000. That means 1 year depreciation gone. So the value of the asset is written down value of the asset at the beginning of the year. So depreciation on this will be 20%. So 28,800 is the depreciation. So from workings we get the depreciation. So depreciation for the year using the WDV or reducing balance method. As a result, the value of accumulated depreciation increases to the extent of 28,800. 28,000. Now this will be called PBIT, and PBIT is 81,200. And now we'll show interest on 10% bonds. On 10% bonds will be 35 into 0.10, and let us assume that we are paying off that interest fully, 3,500. Interest on 6% bonds. On 6% bonds, let me just write bonds, and we already calculated that interest on 6% bonds is given here. 5,000 is 5,000 interest, but you are paying the interest not fully. You're paying interest on 6% bonds. Interest on 6% bond paid is not 5,000 but 3,500, because interest is paid on December every year on the 6% bond. So as a result, you'll have outstanding interest on the 6% bonds, that is 5,000 minus 3,500, 1,500. So this is interest on 10% bond, which is for the entire year, but this is interest on 6% bonds, which is for a shorter period, because the bonds were issued not on the 1st April, but the bonds were issued on 1st June. So interest is done. Therefore, we'll have PBT, profit before tax, is 81,000 minus the interest is 72,700, and let us assume that we have tax of 30%, though not given, so tax will be 0.30, and PAT is 50,890. So tax is an outflow of money, assuming that entire tax is paid. So tax is an outflow of money. Now since we have the PAT determination done, we have to take a decision whether we are making the payment for dividend or not. It says that on 20th March the dividend declared but distributed on 5th April, so therefore no dividend paid. However, dividend has been proposed, so therefore dividend is a liability, because you already declared the dividend, and the proposed dividend is 80% of the capital, but you have not paid that. So 80% of capital is a proposed dividend, and as and when it will be paid, the liability will reduce, cash flow will come. Now we'll see the retained profit. So the retained profit is a PAT plus retained profit opening minus the dividend paid, or minus the dividend payable. So the reserves or the retained profit will be like this. The retained profit will be 252,490. The opening retained profit plus PAT minus the payment minus the liability, and the liability of is deducted here because I've already distributed, so that much of PAT is no more available. From equity it gets converted into a liability. You are bound to pay it now because you already declared. So PAT is done. We'll find the cash in hand. Cash in hand will be the summation of cash inflows minus the summation of cash outflows, and that is 53,000. So cash available for us is 466,000 minus 53,000, so 412,190, and there is a decision there that 50% of the cash on hand will be used to buy more shares of XY. So XY shares will be 50% of that. So the shares of XY will increase to 206. Doesn't matter whether the market price is 100 or 5. Whatever is the money spent is the cost of the shares. Therefore, the shares will increase and cash will reduce. So cash in hand is 412 minus 206. So this is the cash in hand available after making all the payment and after making the investments. So the cash in hand will appear on the balance sheet. No change in the debtor, no change in capital, no change in the bond, no change in the creditor, so the balance sheet tallies. So as usual, we have seen that all the transactions which affect the balance sheet item or balance sheet can be found, the link can be found through the income statement and cash flow. Now let us see the cash from financing. So CFF, cash from financing, we have raising capital, no capital, but we are raising the div bonds. So no outflow, cash from financing minus interest minus dividend, but there is no dividend here, so that is cash from financing. Cash from investment is the dividend received minus the purchase of shares, so minus 186, and cash from operation are the rest of the items, that is sales minus expenses minus the tax is cash from operation. If we sum them up, we'll get cash in hand, which is same which when we have done through a direct method. So cash from financing is positive, cash from investment is negative, and cash from operation is positive. That means you're raising money through operations. So you're generating money through operation and raising money through bonds issue. But the question as usual still remains to be addressed, that is, why is PAT not same as CFO? For that, let us do the indirect method of determining the CFO. The profit is not same as CFO because of depreciation, because of interest, and depreciation is 28,000. Interest, we add this two together, is a non-operating as per AS3. Then dividend is an income and included in the income statement. Deduct that. Then you have the changes in a working capital. Debtors, no change in the debtor, 25 minus 25. No change in the creditors, so no change in the creditor, 150 minus 150. Outstanding expenses In this case it is increased, so that means to that extent you have not paid money, so add increase in outstanding expenses. And there is a stock, the stock has decreased, so therefore add back, because to that extent we have not purchased the stock, but while computing profit we have added that. So therefore the CFO is not same as PAT because of non-cash, because of non-operating, and because of the working capital changes. To sum up, these set of transactions which are there have been converted into opening balance sheet, the closing balance sheet, income statement and cash flow statement. We converted the cash flow statement as per AS3 by showing CFF, CFF, CFO. And we also seen why is CFO not same as PAT by using the indirect method. Thank you.